It shows the expectations of the market and is the price you must pay per unit of earnings. So, for example, if the P ratio of any stock is 29 or 30, what does that mean? To earn 1 rupee of earnings from that share, the market is ready to pay that company a share price 20 times. If the P ratio is 20, it means to earn 1 rupee from that on that share, the buyers are ready to buy it at 20 times, or the buyers are ready to put in 20 times of money. So P of the given company can be compared with P of the competitors in the same industry. I will show you the example. And again, it is not correct. Just if you are comparing the P ratio, you cannot conclude straight away that P of 10 times P is better than 50 times P. So 10 times P means the ratio is lesser. It means the stock is available at a cheaper price. But that doesn't necessarily mean if the stock is available at a cheaper price, it means it is a good buy. We need to find out why the stock is available at a cheaper price compared to other stock at a higher P of 50. If you you know the DMart, Avenue Supermart. The company name is Avenue Supermart, and they are operating the stores with a DMart brand name. Do you know the P ratio of Avenue Supermarkets? It is around 200 rupees. It is around 200. So to earn 1 rupee from the Avenue Supermarkets, the buyers are ready to put in 200 times of money. So a P ratio is very high. As compared to that, of a PSU bank, you might get a P ratio of hardly 5-6 also. I will show you the example. Again, we will go back to the software company ka example to compare the P ratios. We will show you the peer comparison. Yeah, here if you see, I will price to earning ratio of TCS is 38. In the same industry, Infosys is available at 37. Now go down. L&T Infotech. L&T Infotech is a mid-sized company, but their P ratio is 61. It means maybe that company is growing and investors are ready to give more premium to L&T Infotech than the TCS and Infosys. Because maybe they might be seeing more potential into L&T Infotech to become a large cap company of tomorrow. Similar way, Mindtree is getting a P ratio of 50. So as against the established companies of TCS, Infosys, HCL Tech, which are in the range of around 30, 38, or Wipro, it is at 29. Tech Mahindra is also in the same range. So if you see the bigger companies or the large cap companies of IT are having a P ratio of around 30 to 39, whereas the mid-size or small-size companies are having a P ratio of 50, 60. It means they are being sold at a premium rate as compared to the large cap companies. So from here, we will go to the third ratio, that is return on capital employed. So what is return on capital employed? As the name suggests, it is the profit that we earn before interest and tax divided by the net capital employed. So when we say net capital employed, that capital includes the own capital of the owners or promoters as well as the borrowed capital. What is borrowed capital? That is nothing but the debt raised from the markets. So return on capital, it is a profitability ratio. It measures how efficiently a company is using its capital to generate the profits. So what does it mean? Whatever money the promoters or business owners are getting from the markets, equity as well as debt capital, how they are putting into the business, and from that how much profits they are generating. So that is a very good ratio, and which is it is one of the best profitability ratios and is used by investors to determine whether the company is suitable to invest in or not. So I'll again give you an example on that. This time we will take a different example of Larsen & Toubro. Larsen & Toubro, as you know, the company is into capital goods, which is investing into infrastructure, which is building the infrastructure projects. So they require a lot of capital. So what is the return on capital, ROCE of L&T? If you see here, if you see ROCE of L&T is 15.3. So on the borrowed capital, they are generating 15% returns. Whatever the capital they are employing, on that capital, they are generating a return of around 15%. You compare that with GMR Infra. GMR Infra, you know, it is a company which developed the airports. I think GMR developed Delhi airport, and GVK was developed by GVK rather. Mumbai airport was developed by GVK. So if you see GMR, their return on capital is very poor. They have got their return on capital employed is only 1%. If you go down, Ashoka Buildcon, it is another company which is into infrastructure and road development. They have got a return on capital of 20%. HFCL is there. They have got a return on capital of 19%. So this shows you what is the return on capital employed by the companies. And it is again a very good ratio which is used by the investors to know what is the profitability ratio. Generally, when if I am investing 100 rupees if I am putting a capital of 100 rupees, from that I am generating around 15% profit. So which is a very good margin. Then we come to return on equity. There is a slight difference between return on capital employed and return on equity. So what is return on equity? It is again, if you see in return of capital employed, it is a profit before interest and tax. Whereas in return of equity, it is a net profit. And what is the denominator? Denominator also changes. In return of capital employed, it is a net capital employed, which includes the capital as well as debt investments as well. So if they are raising the debts, then that is also forms a part of net capital employed. Whereas in case of return of equity, it is only shareholders' equity. So ROE provides a simple metric for evaluating the investment returns. ROE may also provide insight into how the company is using financing from the equity. So whether they are using their own equity or they are doing business on the borrowed capital, that can be known from the return on equity. A sustainable and increasing ROE over time can mean a company is good at generating the shareholder value. I will show you the example. Again, we will go to L&T ka example only. If you see, return on equity. First, we saw return on capital employed. So for L&T, return on capital employed was 15.3%, and return on equity for L&T is 19.26%. Okay. Just go down and see for Ashoka Buildcon, where their return on capital employed was 20, but suddenly their return on equity has increased to 53. It means they are giving more return on equity. It means Ashoka Buildcon is better than L&T in terms of financials. Can we conclude that? Maybe not. We will need to see another ratio, and that will bring us to the last ratio of the today's session. No, another not rather last. There is another one is left. Fifth one is debt to equity ratio. So what is debt to equity ratio? It is again total liabilities divided by shareholders' equity. So it is a leverage ratio. What do you mean by leverage ratio? It calculates the weight of the total debt and the financial liabilities against a total shareholders' equity. This ratio highlights how a company's capital structure is tilted either towards equity or debt. So whether whatever the company is borrowing, whether how much it is borrowing compared to the whatever equity that it has. So that is known by the debt to equity ratio. Now, if we go back to again the same example of L&T, now you will come to know why the Ashoka Buildcon ka return on equity is more. You see debt equity ratio. Debt equity ratio of L&T is only 1.66, whereas debt equity ratio of Ashoka Buildcon is 9.34. It means they have got more liabilities, and they have got 9 times the liabilities as compared to their equity capital. And as you, if you remember, the return on equity in denominator, they only consider the shareholder equity, whereas in return of capital, it is debt is also considered. Because of that, return on capital employed of Ashoka Buildcon and L&T were comparable, but return on equity of L&T was lesser than Ashoka Buildcon because Ashoka has bought a lot of debt. Their return on equity has increased because debt doesn't form any part while calculating the return on equity. So suddenly their return on equity has increased. So you might think Ashoka Buildcon is giving more return on equity to the shareholders, but there is a reason for it. It is because the company has got more debts. So is it better if the company has got more debt? No. Generally, for any good company, the debt equity ratio around 1 is okay. 1 or maybe slightly more than 1. If it is going beyond 1, then it is an alarming sign. And here for Ashoka Buildcon, the debt equity ratio is 9.34. It is way high. So just by seeing one ratio, you cannot conclude that this company is good or that company is bad. You need to deep dive into details why it is happening. We'll come back to the presentation. The last ratio which I was saying, it is an interest coverage ratio. Again, interest coverage ratio, the interest that you pay on the borrowed capital. So what does the interest coverage ratio gives, how it is calculated? It is calculated by earnings before interest and tax divided by the interest expense. Basically, it is used to determine how well a company can pay the interest on its outstanding debts. So if they have got an interest, earnings are more and interest expenses are low, then it is good. But if the interest expenses are more and earnings are less, then it is an alarming sign, because if the interest expenses are more, it means they have borrowed more capital, they have got more loans, they have got more debts, and their earnings are not substantial such that they can pay their interest expenses in time. So ICR is commonly used by lenders and creditors and investors to determine the riskiness of lending capital to the company. So I will give you a different example of metal company like Tata Steel. All of you must be knowing. So if you do a peer comparison, see the interest coverage ratios. Tata Steel has got an interest coverage ratio of 7.47. JSW Steel, another large cap company, they have got an interest coverage ratio of 8.32. Whereas below there is another company of Jindal, which is Jindal Saw. They have got interest coverage ratio of only 2.72. A higher interest coverage ratio is desirable. So why it is desirable? Because it means the earnings of the companies are more as compared to the interest outgoes. So tomorrow, if there are more interest that has to be paid by the company, their earnings are there from which they can pay the interest expenses. So that gives a comfort to the investors. The company has got a good interest coverage ratio. It means tomorrow, if there are any payments to be made, that can be paid from the earnings which company has got and the reserves they have got from their earnings, from their businesses. So these are the 6 ratios which we saw. First is earning per share. Second is price to earning ratio. Third was return on capital employed. Fourth was return on equity. Fifth one was debt to equity ratio. And the sixth one was interest coverage ratio. Like that, there are many other ratios as well, like net profit margin, operating profit margin. So that also you need to look out for while arriving or while comparing the parameters to select any particular stock. Rather, I will say that whenever you are investing, you should not invest into only a single stock, because that will be a huge bet. As against that, you should divide your investments into multiple stocks, so that because your returns will be generated on your portfolio. When you are investing into multiple things, your overall investment portfolio gives you some returns. At that time, maybe one stock might perform, one may not perform, but overall you will get good returns. But when you are investing your whole money into single stock, your risk increases manifold. So that is why generally I have, as I had advised in the initial session, that for retail investors, the better way will be to invest through mutual funds, wherein your money gets divided into multiple companies. And again, the companies are selected by fund manager based on these criteria only. Fund manager also uses these criteria only. They don't have any other criteria. Maybe the selection differs from fund manager to fund manager. Which fund manager gives more weightage to interest coverage ratio? The other fund manager might give more weightage to the price to earning ratio. So these selection criteria might differ from fund manager to fund manager, but all of them use the same ratios to decide the or filter the companies in which they are going to invest the investors' money. So what are the key points to consider while using this ratio? As I had said, the standalone ratios of the company do not help to reach to conclusion. Just by seeing a P ratio of 38 or 29 or maybe 5, you cannot arrive at any conclusion. It is always better to compare the ratios of a particular company with the historical ratio of the same company. As we did in the Eicher Motors case, we saw why the earning per share of the company has come down to 49. What was the earning historical ratio of the same company before? So when you deep dive into that, then only you will come to know that in last 10 years, maybe the earning per share has increased and now suddenly it has gone down. So then maybe you can find out the reasons for it. You can also do the comparison of the peers of the same company. Yeah.
Sir, there is a question from Chinmay. He wants to ask, can we invest in stocks when the market is at high?
Chinmay, when you are investing into stocks, what is your investment horizon? For how long you want to invest into it? You must have thought some period for which you want to remain invested. What Chinmay is answering?
Chinmay, you can unmute and answer, sir.
Yeah.
Sir, he wants to invest for long term.
Long term means how much? Yeah, hi Chinmay, you can unmute yourself.
Sir, he wants to invest for 1 year and Anurag wants to invest for 2 years.
So that is what the thing is. That is why I ask you when you say long term. You are on one part, you are saying you want to invest for long term, and then you are saying you want to invest for 1 year. Dear, 1 year is not a long term. If you want to invest into stocks, you have to invest for at least 5 to 10 years. If your investment horizon is 5 to 10 years, then only you should come into equities. The question or the problem you are facing, the question that you ask, whether I should invest when the market is at high, it is because your investment horizon is very small. If your investment horizon is very small, that is only 1 year, then it is very risky to invest into equities. Because you don't know what will happen after 1 year. And that is why you are feeling shaky whether I should put in the money when the market is very high, because you don't know what will happen after 1 year. But if you tell me I want to invest for 10 years, then I will say you can invest today. But if you are investing for only 1 year, I would first say don't invest into equity. Equity asset class is not for short-term investments. It is for long term. And when I say long term, it is more than 5 to 7 years. If your investment horizon is more than 5 to 7 years, then only you should come to equity. What you are thinking of, Chinmay, it is a trading mentality. That I want to invest today and maybe after 3-4 months, if the price goes up, I will sell and I will make the money. Remember, money is not made into equity in short term. it is not for making the fast money. It is for making big money. Just think of it.